Welcome back to the show this morning at 6:18. Michael Lebowitz joining us this morning. And yesterday we were talking a little bit about these adult merit badges on the show. And Brent actually ordered a set. If you're watching our live feed right now, you can actually see what these look like. These are iron-on patches that you can put on your clothes to wear to work. So just iron one on your lapel of your suit. I avoided confrontation. I tried my best, minded my own business. These are now called adulting badges, right? So you're doing adult things. We're to the point, I guess, in the millennial phase that now because they grew up being, it was, if you played soccer, everybody gets a trophy. Right. Whatever happens, everybody gets to participate. And so, now they need, I guess, the
affirmation.
It's the ongoing affirmations, yes. Right? That they've done a good job. I paid my bills on time. Oh, what the world is coming
to. Can't make this stuff up.
I know, right? There you go. All right. Michael Lebowitz this morning joined us. They need one that says, I actually went outside today. So, Michael Lebowitz joined us this morning. Good morning. How are you, Mike?
I'm doing great. How are you guys?
Good. Well, it's 32 degrees here. What's the weather there?
Well, we're in the upper 50s. Thank you. Thank you for sending it our way.
Now, isn't that all messed up, right? We're close
messed
to
up. I love
here.
it.
I know, right? And you're doing well. All right. So a couple of things we were talking about in the monologue this morning is that, while this coronavirus has been going on over the last, kind of few days, the Federal Reserve has actually been injecting a lot of liquidity into the system. We saw a $90 billion injection on Wednesday. And you actually wrote a good article that was out yesterday on the website. It's called The Fed's Betrayal. Just in a nutshell, before we get into this other issue, is what did you mean by that?
So during, when was it? Last Wednesday, Powell had a press conference after their meeting. There was one statement that I was just listening, and I'm like, did he really say that? And it just stuck with me. So after the conference was over, I found the transcript. I looked it up, and sure enough, he said it. And basically what he said was, essentially, I'm going to paraphrase here, but that the money supply should rise and fall with the demand for money, which sounds somewhat normal at first. And I think that's why most people just let it go. But the way we were told it works and the way it should work is that the money supply should rise and fall with the economy. When it rises at a different rate than the economy, that's how you generate excessive inflation. And the point of the article is that that's what we've had. If you look at M2, which is a version of money supply growth that the government puts out, M2 has been running a lot faster than the economy, meaning the Fed has been printing more money than the economy needs. So if they print more money than the economy needs, where does it go? And it goes into, like what we're seeing now, speculation.
And this is kind of one of the interesting things about how we calculate inflation is that we don't include, things like asset prices in the inflationary calculations. So while you have this massive inflation in asset prices, it doesn't translate into the coincident indicators of what we calculate as inflation.
And we also don't even count real things that we buy the right way either. I have two examples in the article, housing and cars.
Right.
And I found in 2000, I forgot the prices, but since the year 2000, even before that, Ford has been making the Taurus. Same car. It's changed, obviously. It looks a little more modern today, but it's basically the same car in the same class. And that its price has gone up roughly 50% from 2000 to today. If you look at how the BLS, who calculates CPI, does inflation, it's gone up a minuscule amount over the last 19 years.
Right.
So we're paying 50% more, but if somehow you can buy cars at CPI prices, you're still buying a Ford Taurus for $24,000 versus upper 30s.
Right, but this is where there's this this term called hedonic adjustments comes in, right? Right. It was applied to the example that it was used originally was on computers, right? So and it makes a little bit of sense there. I remember in 1999 when we first started these hedonic adjustments, I bought this server for my office at the time that we were running it. And, this was a server back then that had, maybe, a couple of I think it had maybe 10 megabytes of memory. This was a server for our whole office, right? It still had very small hard drives. It still had a 3.25-inch floppy drive. I mean, that type of, the 1999 type, servers. And it was like 20 grand at the time. Today you can buy a server that's extremely much more powerful than that for $1,000, $1,500, mostly. So yes, you do get a lot more power. You pay a lot less for it. So the Federal Reserve says, well, that's deflationary, right? So you're buying a computer for less money that has more power. But when it comes to a car, cars are cars. Right.
And I think TVs are even a better example.
Yeah.
Look, TVs are a hell of a lot nicer today than 2000. 2000, we had those big box. Mm-hmm. We didn't have digital. We now have the flat screens that are bigger. They're digital. They're nicer, but they serve the same exact purpose. We sit there, we eat our popcorn, and we watch TV. It doesn't change.
Well, no, we do.
It makes it a little nicer.
It's true. It is nicer, but now we binge watch everything, right? So,
right.
Like an entire season of Breaking Bad in one night, right? I mean, yes.
Right.
And that's, by the way, that is an adulting badge for millennials, which is they only watched one episode.
Oh, congratulations.
Yeah, so they get a badge for that.
I guess I don't get one for that.
Yeah, I failed that one too.
Yeah. but no, it is point. But the problem, though, I think with the hedonic adjustments, when they talk about this, and in theory, you can make the claim that, okay, yes, maybe that there's a point for that. But the reality is that we're paying more for things in a lot of areas than what we've paid in the past, but yet wages haven't been growing. So the actual inflationary pressure on consumers is actually much higher because their wages aren't growing to keep up with the cost of living adjustments. And we run this calculation every now and then, and we show this in our articles. But the cost of living, if we adjust that for the rate of assumed CPI since 1970, the cost of living for the average family runs about $50,000, $55,000 now, but wages haven't grown to keep up with that. So there's about a $3,000 a year annual deficit between incomes coming in and the cost of living that's going out. And that has to be made up somewhere, and that's made up in debt, which is why consumer credit debt is now at record highs.
Which is why I think I actually put the graph in the article. 90% of Americans have a negative savings rate, meaning they're living paycheck to paycheck.
Right.
And on debt.
Right. Yeah.
90%. 9 out of 10.
Yeah. Well, but this is the wealth gap, right? The top 10% of the country owns 84% of the stocks. They own, roughly the majority of the wealth in the country. And this is why there's this rising, kind of angst in the economy about this wealth gap that occurs. But even that, when we take a look at things like household, debt to income ratios or debt service ratios, those are, and there's a lot of these charts that are put out that says, see, look, household debt to income ratios are at the lowest level they've been in like 30 years. Well, the problem is that number is massively skewed by that top 10% of people that have the majority of the wealth. That wealth gap is skewing that. Once you strip that out and look at the bottom 80%, look at their debt to income ratios for the bottom 80%, it's a vastly different story, and it's not one that's very pretty.
Right. Someone like Bill Gates can probably alone cover up for hundreds of thousands, maybe millions of people. Right. If you just take the average of him and all those people. So, you have a bunch of these Bill Gates running around, and it makes the average look okay. And I would just say okay. Not great, but okay. But you strip out those high wage earners and high asset holders, and you're left with 90%.
So let's go back to this issue. I don't want to get too far off course here because we're talking about this inflationary pressure. The one thing that has really kind of given cover to the Fed and really to the government. The government's running $1 trillion deficit right now, And, really there's kind of no end in sight. There's no real control of spending in government, but it's put off on the point that, hey, it's okay because there's no inflation, right? We can run a deficit. We can do this spending. We can, run these other type of monetary interventions, et cetera, because there's no inflation. In fact, this is what's given rise to modern monetary theory, which is basically we can just use government debt and pay for everything because there is no inflation. But to your point, though, what you're talking about is that actually there is inflation because it's showing up in the M2 money supply.
There's inflation. And maybe after we come back from break, we can just go through a little example where we go on a desert island and we have a fixed amount of money and we can talk about inflation, and then we can change the example around a little bit, because I think this is a big deal and it's not understood. And it's not understood because of the way the hedonics, what we talked about with auto prices, TV prices, all kinds of prices make us think, and it's ingrained in our head that inflation is 2%. Maybe a little less than 2%, maybe a little more than 2%. Well, but we got a 3% raise. So that's great.
But I can tell you right now, your example's not going to work with me, because if you put me on a desert island with a pile of money, I'm just not coming back. You talk to pretty much anybody, they'll tell you that their real inflation is much higher than what the government says it is. Just healthcare cost alone.
Right.
There's a lot of inflation there that's not picked up, housing prices, et cetera. But just for the break, you're talking a little bit about this idea of being on an island. So, all right, so let's go with this example. You and me and Brent and the skipper and Gilligan and Marianne and Ginger, we're on an island with a pile of money. What happens?
So Ginger, Marianne, and I live in our house, and you guys all have your little hut.
So I'm over here with the professor, what you're telling me.
That's not the episode I remember.
Exactly. Although Gilligan did try to hook up with Marianne a couple of times. He just never closed the deal.
Right. So we have whatever money was in our pockets when we landed on this desert island.
Right.
So there's a fixed sum of money. And when there's basically inflation is solely about money, how much money there is. When the amount of money increases, you get inflation. When it decreases, you get deflation. So we're on this desert island and we have a limited amount of money. Now we may bid up, between us, there's one bottle of water. I may say, I'll buy it for $2. You'll say $3. But ultimately, the price is governed by how much money there is. And if we pay $20 for a bottle of water, we have that much less money to buy coconuts or to buy huts or to buy whatever we want to buy.
Right.
So you have relative inflation. The price of water may go up while the price of huts may go down. And there's price differences between things. But overall, the level of prices will not change because it's fixed to that amount of money. And that's the way our economy works, too. It's no different. If the supply of money doesn't change, there is no inflation or deflation. It's just the prices of things are changing relative to each other based on supply and demand.
Right. Well, and again, this is just kind of a basic theory that I think most people understand, is that if you have a whole lot of something, the value of whatever that is less. Right. So, if things are fair, for instance, a Ferrari is a car. Right. But there's a limited number of Ferraris out there to buy. So they have a very high value versus a Toyota Camry, which are produced in mass quantities. So those have less value. And there's others. And it's also the value that we attach to things. But if you're just printing a lot of money, the value of that currency will go down because there's so much of it, and vice versa.
Right. If you make $100,000 a year and don't borrow money, you're going to spend forget taxes. You're going to spend $100,000 a year. Whether you want to spend that on one big fancy car and a bunch of little things or vice versa, it doesn't matter. The prices are going to change based on how you spend that money. And that's what so few people understand, is that inflation is really just all about the supply of money and how much there is. But it's easy. The government gives us money supply numbers, and there are different ways to calculate it. But we know the money supply has risen about 6% a year for the last 20 years. The government gives us inflation numbers. They've risen by about 2% a year for the last 20 years. That doesn't make any sense. When we get our 3% raise, we're like, yay, we're making more than inflation. Our wealth should be rising. But really, our wealth is falling because the real inflation, what we're really paying, is 3% more than that 3% raise.
Right. And then again, that's what, when we kind of look back at, the savings rate of the average American, blah, blah, blah. that is what bears out, and why there's this disparity in wealth and disparity of participation in the economy because of that differential between what the real cost of living is, inflation, and what we're actually getting in terms of wages. It was interesting. We heard a lot last year about that wages were going up, people were making more money. Isn't it great? And then in the month of December, we got the revised wage data, which wiped out all the wage growth going back to 2017. Inflation is still going up, and the cost of living is still going up. But again, a lot of this really began to become more problematic. Prior to about mid-1990s, we actually measured inflation on a basket of goods. It was at least a more real measure of what was happening with inflation. But under the Clinton administration, we brought in the Boskin Commission. They recalibrated how we calculate inflation for one specific purpose, which was to lower the amount of Social Security payments that went out. So if we lower the calculation of inflation, we pay less out in Social Security payments on those annual cost of living adjustments. And we keep kind of goal seeking, in our inflation measures, and also in our GDP growth numbers, we keep adjusting those mathematical calculations to goal seek an outcome. And then we look at those mathematical calculations. Well, those must be right. The government produces them. But these are heavily mathematically adjusted numbers to create an outcome that the government wants to produce. I'm not saying that's criminal or anything. It's just a function of how things work. And so that's why real inflation now is no longer represented by what CPI says.
We all know that if they reported inflation at 6% and we were getting 2% raises, much higher odds of riots in the streets.
Right. Yeah.
Right. Really, what would happen is, corporations would eventually have to pay that, and they'd be losing money.
Right. The cost of wages is a direct, impact to bottom line profitability. But it also comes across to the problem that you have that inflation is also matched by interest rates. And this is another problematic issue for the government right now, in particular, when you're running $1 trillion deficit and $23 trillion in debt, is that the one thing you cannot afford to have happen. And, we've had, the bond gurus out now since 2013 talking about how rates are going to go up to 4, 5, 6%. Jamie Dimon just last year, rates need to be closer to 5%. You can't have that happen, because not only can the average American not afford higher rates because their cost of borrowing goes up, cost of buying a car, cost of buying a house, et cetera, which freezes up the majority of the economy, but just servicing the debt becomes problematic if you have a surge in rates. So since interest rates are ultimately a reflection of economic growth and inflation, not surprising that we have inflation and interest rates and economic growth all running right around 2%.
And again, if the Fed kept the money supply at the rate of growth of the economy, call it 3%, whatever that may be, there would be less money. And what happens to interest rates? Interest rates are the cost of money. So there's less money. There's same demand for money in theory, right? So interest rates go up. Right. And another reason why the money supply is 6% over the last 20 years. But it's being masked by inflation rates, by government spending to make us all feel better, put a couple extra shekels in our pockets. It's I call it a scheme in the article. Maybe it's a scheme, maybe it's not, but it's certainly a ruse, and it makes us think that things are different than they are.
Right. And it's interesting too. I actually have an article out this morning called State of the Markets. It's on our website as well. And in that article is a chart showing government spending as a proportion of GDP. And actually over the last 3 years, if you strip out government spending, which is part of the GDP calculation, economic growth has actually been negative for the last 18 to 24 months. And because we've seen so much of this government spending coming into the economy while the economy continues to remain sluggish. But I think that tells you really a lot about what's happening in the underlying economy as well.
Exactly. I have a similar graph in my article, which shows the change in GDP minus the change in Treasury debt outstanding. Very similar concept, right? And there's basically been zero economic growth in the last decade. And the government's buying growth.
Exactly. Brent, did you just pick up on what just happened there?
Which one?
The one where Mike just went, he gets an adult merit badge for my chart is better than your chart. So.
Chart war.
One-upping the host.
Everybody get up!
Welcome back to the show today. I'm your host, Lance Roberts. Michael Lebowitz joining us this morning. And, one thing that drives the economy and the markets is confidence, right? How we feel about things. The better we feel about things, then the more that we'll go out and make purchases and we'll, acquire things. And that's, since consumption makes up about 70% of the economy, confidence is, of course, very important. And right now, consumer confidence is at some of the highest levels in history, and really can't really even get much better than where it is now. I mean, it's pretty much, from the polls, Americans are just about as confident as they can get. I guess that depends, though, Mike, a little bit on who you're polling, though, right?
We came across an incredibly interesting graph yesterday, which we shared on RIA Pro with some comments about it. And the more I look at it, the more fascinated I am by it. Basically, what they do is they take consumer confidence for people aged 35 and younger and compare it to consumer confidence for older people. And I forgot the age group, but I believe it was 65 and older. And since 1980, consumer confidence for younger people has always been higher than consumer confidence for older people. And that makes sense. They got their lives ahead of them. They're enthusiastic. They're probably getting better raises. Older people are retiring. They're starting to live on Social Security. They're not spending as much. This data, again, goes back to 1980. In 2000, right around the recession and the tech bust, it went very slightly negative. And just as a point of reference, it oscillates between a number of 10 and 30, 35. It hit just slightly below zero in 2000. Currently, it's minus 16. And it's been trending much lower over the last 4 or 5 years. Mm-hmm. And basically, what I think this is telling you is that younger people are starting to get pretty depressed. They're losing confidence, right? Mm-hmm. They're saddled with massive student loans. They can't afford to buy houses. Housing inflation has been off the charts. Their wages are not that great, especially coming out of college in your 20s. Mm-hmm. A lot of them are living at home because of their student debts, because it's very expensive, especially in the big cities. Even rent is very expensive. And at the same time, older people, and not all of them, but some of them, they've seen their house prices increase rapidly, so they got a lot of equity in their house. There you have the 401ks, so their 401ks are going up with the stock market. Right. The younger people, other than 1 2/3 share of Tesla in their Robinhood accounts, aren't benefiting from this at all. But it's the first time since at least 1980 that we've ever seen this, and it's incredible. I think what this explains is why Bernie Sanders is so popular among younger people, why Elizabeth Warren is popular.
Well, yeah, because they're catering to the exact thing that is burdening them the most, right? We're going to pay off your student loan. We're going to, basically give you, free this and free that and free everything else. And, that sounds great. And, it's interesting because you and I were having a conversation yesterday about this kind of whole, age group that's coming up. And it's a very different world that they're coming up in. And, automation that we've got now and what's happening with productivity. Productivity is, it's interesting how we measure productivity, right? Productivity is measured two ways. One is productivity is measured on the output of things that we produce. That's at very, very low levels. So, productivity has been declining now for quite some time. But productivity, if you look at it in terms of automation, because of technology, because of things that are going on, we're actually more productive than ever, right? But that productivity has a dark side of which it suppresses wages. One person can do more work with technology. And just this radio show is a good example of this. We run an audio stream, a video stream. We do all the production and everything else all in-house. And to run a radio show 20 years ago would require 3 or 4 people. You'd have to have an engineer. You'd have to have a production guy. You'd have to have somebody else to actually, run the program and put it all out. Today, Brent does it all by himself because of technology and because of computers and how fast that we can do things. So it's reduced the cost of running this radio program. It's been reduced a lot because we have to pay one person to do it versus 4 or 5 that you'd have to have just 20 years ago. And so we're seeing that same impact. And you and I were talking specifically yesterday about robo-taxis. This is kind of one of the, kind of the hopes for Tesla is that robo-taxis are going to take over the world. That's not a great thing. It's not a great thing for the millennial generation come up. I mean, we've got a lot of millennials that are coming up now. They're Uber drivers, they're Lyft drivers, they're Grubhub drivers, they're DoorDash drivers, whatever. Because of that technology that's created convenience for Americans, it requires people to do those jobs, but those jobs are low wage paying jobs, which will be eliminated entirely by robot taxis. So what are those people going to do for a living once they no longer have a job? Right. And so this technology is suppressing wages across the entire category for that age group coming up, which is making it harder. That's why, again, with that and housing prices and low wage growth, they're really caught in a bad situation.
So where is wealth being generated? And it's largely being generated from the stock market. Besides payrolls, it's the stock market. And who's benefiting from that? The older you are, the more money you have, the bigger your 401ks are, et cetera, et cetera.
The key name there is that the older, if you're older, you've probably accumulated some wealth that you actually have money to invest with. Most young Americans don't. Yeah, they may have a few dollars here and there on Robinhood they're speculating with.
Right.
But by a large majority, they don't participate in the markets. We go look at the statistics, right? The top 10% of income earners own 84% of the stock market. So there's not a lot of participation left over for the other 90%.
And what I would say to this whole thing is be careful who you blame. It's not necessarily, look, a lot of these people took on student debt and they probably shouldn't have, or they should have worked through college, this, that, or the other. And Sanders and Warren are just filling in a need. This problem dates back 20, 30 years, Democrats and Republicans, for bad policy, bad fiscal policy, bad monetary policy.
Right.
And what we're seeing now are the results of that. So be careful where blame is placed. Because this is on all of us, and it goes back a long time.
Right. No, and this is always kind of interesting because when you start talking politics, everybody's quick to point the finger to the other side and say, well, the Republicans did this or Democrats did that. But to your point, though, this has been going on since 1980. We started deficit spending under Reagan. Then pretty much politicians found out pretty quick that a little deficit spending was good, so a lot must be better.
And by good you meant get them reelected.
Exactly. And it's been growing ever since. And so to your point, we've stopped running a budget altogether now in Congress. We haven't had a budget in government in 10 years.
Right, and this all goes full circle. So the more money you want to supply to the market, but the more you want to keep inflation lower. And this goes back to what we were talking about earlier. It just forces the government to perpetuate the scheme, the unproductive scheme. And the results are showing up. I think it actually, remember, Obama ran on change. Trump was definitely change. He was a non-political entity running, right? And now you got people like Sanders and Warren. I mean, it's clear that people want change. They don't know what kind of change. I don't think so. But they know they don't want the old establishment running the government anymore.
Well, look, I think that's, it's interesting you say that. You don't want older people running the government, but then you look at Elizabeth Warren and Bernie Sanders, right?
No. And I didn't say older people. I said the establishment.
That's true. Right. But no, it's true. But I mean,
look at Biden. Biden is the establishment, right? Yeah. He came in, fourth in Iowa?
Yeah. Well, but, to your point, though, I don't think, people want change, but interestingly enough is they don't want the right type of change. And it's because they don't really know what change they should want. They don't understand it, right? So I've got this burden. I want somebody else to take care of it. That's great. And you'll have a short-term fix, but you'll have a long-term problem out of that. Paying off student loans doesn't solve your long-term problem because financial education and financial abilities are a different structural problem altogether. So just because I alleviate you of one debt, you're just going to run out and run up another debt in the process to replace it. So you're not going to improve your situation by doing that. But we're going to permanently change the outcome for the American trajectory of the economy by making these changes more towards socialism and away from capitalism. And that's a long-term consequence that voters aren't going to like down the road. And it's interesting that you've got a whole generation of people voting for things that are socialistic when you have an entire country that was built upon the fact that these were people fleeing countries that were socialistic and communistic to get away from that, to come here to a capitalist opportunity so they could create wealth and have better prosperity. And now we've got a generation that wants to get rid of that.
Now, and capitalism gets a bad name, but I think it's because we're not really running a capitalistic society right now. This is an oligarchy run by corporations.
And that's a true fact. And again, I think that's where, you see that really kind of coming kind of coming full circle now with the whole wealth gap issue. People are recognizing that more and more, and it's becoming much more of a problem. Now we've got proposals to tax the rich more and all these type of things, and it's just it's becoming an evident problem where it wasn't so much of an evident problem 20 years ago.
Right, and none of the answers being put out there are the right answers.
Right.
They help someone or some group of people, but the answers are hard. They're difficult, but they are necessarily if we want our children to live in a country that like the one that that we remember.
Yeah, no, it's absolutely true. We're not willing to take the short-term pain for the long-term gains, and that's always. We want we want to have everything now and let everybody else deal with the problem later. And that's
sadly, that is it. That is the problem.
Exactly. All right, Mike, thanks so much. We appreciate your time today. That wraps up the show this morning. It's the Real Investment Show. Get by the website. Mike's article is on the website right now. It's called The Fed's Betrayal. Also, our new article out this morning, The State of the Market, is on there as well, talking about a little bit about the market relative to the economy. After the State of the Union speech on yesterday. So that's all on the website today, right now at realinvestmentadvice.com. While you're there, send your questions, comments, to subscribe to our newsletters, get our latest updates, our podcasts. It's all there at the website, realinvestmentadvice.com. That's realinvestmentadvice.com. Have a great Thursday. It's pre-Friday, and the weekend's coming up on us, so have a great day, and stick around because Chris Salcedo's coming right up.
It's a rich man's world.